Hi, welcome to what I think will be a fairly brief video, an introductory video to current liabilities and contingencies. So this is the first time we've crossed over in this course into the liability side of the balance sheet. And again, the course is designed to examine the accounting for the operating activities, and the current liabilities are often associated with our operating activities. They arise as amounts we owe in connection with our operations, paying our employees, paying our suppliers, etc. So let's start with a quick definition of a liability. A liability, as you learned in the first lecture in the course, is a present obligation to sacrifice assets in the future because of a transaction or event that happened in the past. So let's look at the key qualifications for liability. Global future outflow arising from present obligations to other entities, obligations that transfer assets or provide services, and it results from past transactions or events. And liabilities in general are reported at the present value of future outflows. You'll be looking at liabilities significantly in Financial Accounting Reporting 2, your next course in this series. Those will be non-current liabilities, and such as bonds. In this chapter, we're looking at current liabilities. So let's talk about what a current liability is. Current liabilities are obligations payable, liabilities payable within 1 year from the balance sheet date. The balance sheet date is the date we're preparing the balance sheet now for. And if an operating cycle at this particular company is longer than a year, the current liability is payable within one operating cycle. This is rather rare. Think of companies like Boeing that make airplanes. An operating cycle may be longer than 1 year because it takes longer than a year to build an airplane or a ship. And so for those companies, the current liabilities are all those liabilities payable within one operating cycle. But for most companies, it's payable within 1 year. These are obligations expected to be settled with current assets or possibly another current liability. Current liabilities are important for assessment of liquidity. In liquidity assessments and financial analysis, analysts are going to compare the total current liabilities with the current assets. Essentially, that is the amount of assets that will turn into cash within the next year that are available to pay the current liabilities, the amounts we'll owe in the next year. Now, you don't have to be overly concerned if in any particular period current liabilities exceed current assets, because most companies have alternatives for managing such imbalances. Those might be paying the bills with profits from next year's operations, or maybe drawing on a bank line of credit where the bank will lend short term for them to meet these liabilities until the cash comes in. Now, current liabilities are reported at maturity value, that is, at the present value or the face value, if that is at the face value of the amount. Now, what did old Steve just say? He said liabilities are reported at the present value of future outflows. And then on the same page, it says current liabilities are reported at maturity value. What gives here? Well, what gives is that the present value of a current liability is not substantially different, is not materially different than the face or the amount owed. Because if we did the calculation, the present value calculation to discount the amount it wouldn't discount it all that very much. Thus, relying on the materiality principle, we don't do the present value calculation on current liabilities. We do that calculation on all other liabilities. You're going to see a lot of that in your upcoming courses. But with current liabilities, we just report these at the amount we'll pay in 30 days or 60 days or 4 months. All right, now we're going to look at several types of current liabilities, several common types. These types arise from the transaction that gave rise to them. So one common current liability is accounts payable. These are typically obligations to suppliers of merchandise or services that were purchased on account. The accounts payables are evidenced by an invoice. When that invoice is received, we debit the inventory or whatever we got for the from the provider, and we credit accounts payable. So inventory is plus asset, and accounts payable is plus liability. So we debit the inventory or whatever we received that we now owe the vendor for. Maybe it was a service and we're debiting an expense. And then we credit accounts payable. We credit the liability accounts payable to increase it and indicate on our accounting records that we have a liability. When we pay the liability, we zero out the amount we owe because we no longer owe it, and we now have less assets. We now have less assets. We credited the asset account cash. Okay, so that's one type of payable. Now here's a look. I have this one indented a little bit. The reason I have it indented a little bit is this is a specialty accounts payable. Trade notes payable. These are similar to accounts payable. They arise from transactions with trade suppliers. They're often evidenced by a written promissory note, and they may bear interest. So if you see that term come up in your profession, in your career, that's what a trade note payable is. But it's very similar to an accounts payable. Short-term notes payable. That's another type of liability, current liability that might arise. These are bank loans, typically loans with any counterparty, but they have a maturity less than 1 year. This is the most common way to obtain temporary financing. So businesses, when they need some quick financing, they call their bank partner. Most businesses have a banking relationship with a bank officer, and they obtain a short-term note payable. Under this transaction, the company borrows cash from the bank and signs a promissory note. That is a promise to pay. These are often arranged under a, quote, line of credit. This is an agreement to provide short-term financing when needed. Might also hear these called revolving lines of credit. You know what? In essence, your credit card is a line of credit. So that's essentially what it is. It's essentially the company's credit card. It's the company's credit card with a bank. It's an arrangement with a bank for no questions asked, or few questions asked financing up to some amount. Short-term notes payable are interest-bearing. Secured loans. This is a liability that is often not a current liability, but it can be. A secured loan, when you see the word secured, what that connotes is that the loan is a loan with an asset pledged by the borrowing entity as collateral for the loan. Your car is a secured loan collateralized by the car. That's why they can repossess it if you don't pay your car loan payments. That asset pledged is often inventory or accounts receivable for companies. Commercial paper. You'll see this with big companies. Commercial paper is a current liability. These are unsecured notes. They have no security. They have no collateral associated with them. They're typically sold in denominations of $25,000, and their maturities range from literally one day to about 9 months, but most of them are very, very short term, a very few days. 270 days if you're doing so that's about 9 months. The interest on the commercial paper is usually discounted at the issuance of the note. So one company calls another and makes a commercial paper borrowing, and the lender simply holds back the interest, and so the company borrows 1,000. The lender will send them something less than 1,000, and the company must pay them back 1,000, and that will how the interest will occur. These are usually issued directly to the lender, and they are backed by a line of credit with a bank. They're very low interest rate, and they're accounted for just like any short-term note. You'll see that later in this discussion, in this chapter, this module. Accrued liabilities. This is going to be a big part of your early career. This is a big part of our auditing because we have to audit, we have to audit these accruals. Accrued liabilities are expenses that have been incurred by the company but not yet paid. We record an accrued liability via adjusting entries at the end of the reporting period. Common examples of accrued liabilities are accrued salaries, accrued wages payable, accrued income taxes payable, accrued interest payable. See accruals of all of those upcoming. Accrued interest payable. This is the accrual that arises in connection with notes payable and other forms of debt. Accrued executive compensation. These are wages, salaries, commissions, bonuses, stock compensation plans, and pensions. They arise from those agreements with company management. They arise when employees have provided services but will be paid after the financial statement date. They're recorded as adjusting journal entries. We'll see an example. In sick days and other paid future absences. So employers accrue an expense and related liability for employees' compensation for future absences. You'll know this as vacation pay. If the following are true, if the amount is attributable to employees' service already performed, the paid absence can be taken in a later year. Company policies allow it. The benefits vest. In other words, they would be paid if the employee were terminated. Or the benefit can be accumulated over time. The payment here is probable. The amount can be estimated. The payment must meet the liability criteria of being probable, and the amount must be estimatable. This is an accrual that's made by all companies that allow employees to carry over vacation or sick days. So the point here is that we're going to match. Let's say that this is you have done this for your company. The company is going to match the cost associated with your extra work this year to the revenues you helped produce this year. And then you have the right in the future to take some time off, and you'll get paid this amount that you accrued in the year you did not take your vacation. So what this accrual does is it successfully matches your extra work in one year against your a little extra time off in the future year because it's owed to you. We'll see an example of this later in an upcoming video, an upcoming case. Annual bonuses. Annual bonuses are bonuses are compensation, and they're compensation in the year earned. So when you have a bonus, when you're awarded a bonus, this is compensation expense to the company, and it's recorded in the year you earned the bonus. Any unpaid bonuses are accrued at year end and reported on the balance sheet as a current liability. Typically, many companies pay the bonus in early in the next year because many times the bonus is based on some measure that can only be made at the end of the year. For example, you might be a manager with a bonus contract that says if total sales at year end are X, your bonus is this amount. Well, we're only going to know that amount when the year ends. So that bonus will be accrued at year end and then paid to you next year. Liabilities arising from collections in advance from customers. Give you some examples of this. Refundable deposits, such as your apartment deposit. This is recorded as a liability, and then that liability will be zeroed out if the company repays their refundable deposit to the renter, in this case, to the customer. It's converted to revenue if the refundable deposit is forfeited. For example, in the case of your apartment rent, if there was some damage and they keep the money to pay the damage, they will then match that revenue against the expense it takes to fix, to remedy the apartment damage. Advances from customers. This is cash received from customers that will be applied to the purchase price when goods are delivered or services provided. Here's a couple of examples. An example is season sports tickets, subscription revenues, airline tickets. With season sport tickets, you buy them before the season, and then the team earns the ticket revenue as the games are played and you attend them. Subscription revenue, you subscribe to a podcast service, to a streaming service or to a magazine, and then as they provide you with the content, they can recognize the revenue, recognize as revenue the cash you've already paid to them. Same thing with airline tickets. We have to buy those up front, but they only record it as revenue when the flight has taken place and they have successfully delivered you to your destination. These advances from customers are recorded as a liability, and it's typically called something like deferred revenue. Some other companies might call it advances from customers. Gift cards. This is an emerging topic. So many gift cards. So we're going to see an example in here of how to account for gift cards. Here's a brief look at it. For example, you buy a gift card, the company debits cash and credits deferred revenue. Then, when the customer brings in the gift card and redeems it, they zero out that deferred revenue and then recognize the revenue when that card is used. We'll see an example of that coming up in this module. Collections for third parties. Ooh, this is common. Companies often make collections for third parties and then periodically remit these amounts to that third party. The classic example, the omnipresent example virtually, is sales tax. When we make a purchase, when a customer makes a purchase, we charge them the sales tax as well, and then we debit that cash, but we record it not as revenue, but as a sales tax is payable to the taxing authority. We'll see an example of this later in this module. We'll do a case on sales taxes. Payroll accounting. All companies incur liabilities in connection with payrolls. Here's the payroll-related liabilities, the very, very, very common ones. Salary and wages payable to employees. Those are salaries and wages earned but not yet paid at year end. Employee withholding taxes. Oh, don't we love these? This is when the employee, we withhold federal income tax and state income tax and any local income tax and the FICA, Federal Insurance Contributions Acts. That's your Social Security and your Medicare. FYI, those rates are 6.2% is the Social Security rate of the first $142,800 you earn. The Medicare tax is 1.45%, plus additional 0.9% on wages in excess of $200,000. We will see a case of this coming up in this module. Employers' payroll taxes. This is the not only do we pay taxes, but the employer matches them. The employer has to match your Social Security and your Medicare. So if you own a business, that becomes one of the costs of being in business at those same rates. Federal unemployment taxes, that's paid by the employer. State unemployment taxes, in Missouri, that's usually 5.4%. Federal unemployment taxes are 6% of the first $7,000 earned by an employee, less any percentage paid to a state unemployment tax fund. In Missouri, again, the company will have paid something. So if 5.4% is paid to state, the federal unemployment rate is 0.6%. Voluntary employee deductions are yet another payroll payroll-related liability, and payable to a third party. Remember that concept that we talked about a moment ago? Collections payable to a third party. Well, this is an example. This is your portion of your medical insurance premiums. The company withholds them from your check and then pays them to the insurance provider. Your portion of the dental insurance premium, the company withholds it from your check and pays it to that insurance provider and pays their portion as well. The employee's portion of any insurance premium, such as eye care, life insurance, disability, any contributions to savings plans you make, the employee makes. Any contributions to retirement plans the employee makes, and union dues. Okay, we'll see an example of this upcoming. We'll see a case with that. Fringe benefits. These are the employer's portion of the medical insurance premiums, the employer's portion of dental insurance premiums, and the employer's portion of other insurance premiums that the employee is due under the fringe benefits agreement of their position. Note here, Just know this: if you're a self-employed person, you must pay both the employer and employee portions um, of those of all the taxes. So keep that in mind if you're going to go into business for yourself. And also, this arises in my personal tax return for work I do on the side as a consultant or a contractor. So keep that in mind if you're a self-employed individual. All right, that is an introduction to current liabilities. Thank you for your attention. Now we will turn our attention to a payroll accounting case, and we'll talk about what we were just talking about in general there. Right. I will see you on that video, and have a wonderful rest of your day.